Jamshedpur Management Association, and I welcome you all on behalf of JMA. Today's Enriching Life series session is on financial wealth management, and I would like Mr. Amitabh Bhattacharya, Secretary JMA, to please set the context of the session. So, over to you.
Yeah, thanks, Asmita. I think people who have heard me and Vikas speaking just before have got the context. So I don't think it's much needed now. But then welcome everyone, whoever is the in this call, in this online session. And I thank Vikas from ICICI to take out time and deliver this session. I think Enriching Lives series is what we started during when the pandemic started 2020 March. We started this, and the main aim was how do we value add to the lives of the people, because every day in the busy schedule of work or home priorities, we somewhere miss certain things which are also very much important in the life. That's We started with something called spirituality, we started with something on the health. So we had the speakers of the like of uh, mm, uh, Dr. Shikha Sharma, who is a well-known nutritionist on this Enriching Life series. We had Ambassador Deepak Bora, who is also a great speaker on the national issues. So there are various other facets of life other than your normal work. I think we should, and it's in our endeavor is that we bring the experts in those area who can actually give some inputs and which may be valuable. So today's session, as I understand, is something which ICICI has carved out for the people who are having income more than 25 lakhs per annum, and how they can better do a financial management. I think that's something which Vikas will be talking about during the session. And welcome you, Vikas. I think it's pleasure to host you.
Thank you.
And look forward to your session. I think that's what I can say. I think that's I will then hand over it to Ashmita to back to Ashmita. And I will urge the people who are connected today to attend such programs and spread this message to their friends, colleagues, family members. JMA is, see, we have just I'm putting up this message here once again. JMA has, there is no membership fee, there is nothing. We want more and more people within Jamshedpur, and maybe if even if now in the on the virtual programs beyond Jamshedpur to connect to JMA is a good platform where you get some good, whether it's our normal training programs or business games or the competitions or the talks. Anything you JMA, there's a quality, there is an so you will experience that, and that's why in the Enriching Life series also we have Mr. Vikas from ICICI, which is one of the leading bank in this in India. Yes, and yes, so that's what I was saying. Yeah, you kindly encourage your colleagues, friends, family members to join more and more into such kind of programs, and especially Enriching Life series. It's not related anyway to work or so-called management. It is more to how do you can improve your life, and financial management is a very important aspect of that, I think. So with this, I will not hold because I will hand over back to Ashmita for taking the program forward. Thanks.
Thank you,
Thank
sir.
you.
Thank you. Now I would like to request Mr. Kumar Ranjit, Head Key Relationship, Tata Steel of ICICI Bank, to please introduce our speaker of today.
Thank you very much, Asmita. Thank you very much, Amitabh sir. I once again welcome all members of JMA for participating in this webinar. I'm sure this would add value to their life, and this would prove to be a very, very good session. So first of all, let me introduce myself. My name is Kumar Ranjit. I'm Key Relationship Head. I hope I'm audible, Asmita. So
Yes, sir. Yes.
my name is Kumar Ranjit. I am Key Relationship Head for Tata Steel, based out of Jamshedpur. Simply put, by virtue of being a Key Relationship Head for Tata Steel, you can treat me as a one-point contact for anything and everything which Tata Steel, either from corporate side or Tata Steel employees from retail side. If you want any solutions, probably you can reach out to me as a one-point contact, and I will connect you to everybody in the system who would probably give you the solution from ICICI Bank. So this is all about me, Kumar Ranjit. So coming to today's guest, Mr. Vikash Mishra. He is a veteran of banker of 19 years, in banking and wealth management. At present, he is heading Wealth Select Client Segment at ICICI Bank. Prior to ICICI Bank, he has worked for Citibank and Tata AIG. He is a a postgraduate and MBA Finance from Symbiosis Center for Management and HRD. So, and he has handled various responsibilities in business development and products. So he has a long career and he has a very keen interest in financial market. So not taking any time more, I request Mr. Vikash Mishra to take over the session. All yours, sir.
Thank you,
Uh,
Ranjit.
Uh, Vikas, sorry, just a clarification, Mr. Ranjit, because there is a lot of participants in on this are from other than Tata Steel because it's a JMA program, Tata Motors, and maybe other
Right,
companies
sir.
in
Right.
Jamshedpur. So, as you said, anybody can reach out to Tata Steel, but then are other organizations also free to reach out to you, and will you help in that
Yes,
regard if you can
anyone, sir,
clarify that?
anyone from Tata Group in Jamshedpur, Pan India, they are free to reach out to me for any solution which they might require. I could be a one-point contact for entire Tata Group,
Okay,
including
great.
Tata Steels.
Thanks. Vikas, go ahead. Sorry for the interruption.
Thank you, Ranjit, for the warm intro, and thank you, Mr. Bhattacharjee, once again for giving us this opportunity to come and talk to the esteemed guest today. Thank you, Smita. So I think when we met sometime back last year, we were under the gloom of COVID, and we of course had multiple waves also in between. And I think, as can happen with investments, today when we are connecting, we again have a big fear around us through the war which is looming in Ukraine and Russia. So I think this is a reality of investing and investments life, and one really has to figure out a way how to manage these events, these stresses, and perhaps wherever possible, one can actually maximize and make the best of such events which are not necessarily very good as far as on the personal space is concerned. But so our focus today will obviously be to not focus on anything which is happening around, but stick to the basics. And basics do not change even if there is an event. And that's what we have witnessed exactly what happened after COVID. So not long back, 2 years, or rather very long time back when the world was normal pre-COVID, 2 years back, and when the COVID news broke, and we saw what kind of big sharp correction happen in equity markets. But at the same time, we have witnessed how quick recovery could be if the problem can be handled. I think the same thing happens also with events like what is happening around us today. So if there is a war which is ongoing, once it gets controlled, or if there is a ceasefire, then a lot of it will come to normalcy very soon. So I think, disregarding the noise around us, ignoring it for the moment, our idea and our focus today will be to stick to the basics of financial management, what one should do at all points of time. And I think these are golden rules which will help us keep us in good state in all situations and circumstances. So with that as a background, I would just want to quickly give a snapshot of what I want to cover today. So a lot of it is a lot about individual. So in this entire approach of financial planning, there is nothing called one fit formula, or there is a one approach or a one portfolio which fits all, right? So each individual has a different risk appetite. Each individual is at a different lifestyle stage, and hence the financial planning process should cater to and respect the individuality. And that is how we want to approach this subject today. And that is how we also approach this entire exercise when we are drawing a financial roadmap for any investor. It and it entails not just managing finances, but it is also about managing contingencies, which one can do by covering oneself adequately through health and wellness plan and through covering for life insurance. So these are key aspects of financial management. And I think the last important point is, while we do it, we also have to plan succession in a very systematic and proper way, rather than leave it to chance and destiny, or for our successor to fight it out through the laws of the land. So some step on time can actually take a lot of agony off, right? And lastly, and very briefly, we'll also try to touch upon, as a bank, how we can really partner each one of you on the session today, and if we can help you around all these requirements which we come across in financial planning. So before I really get going, I think I'll just let some thoughts. Uh, Probably you can go through these questions, just answer for yourself. You don't have to post it or answer in public. But I think these are important questions one want to have answers for at all points of time. And as something as whether one knows the amount you save every month. Are you one is aware of the percentage? And we realize that a lot of people are not aware because it savings actually becomes earning minus investments. So whatever is left goes into savings. But if you alter the equation and if savings is a defined amount, then we also start managing our expenses until the earning doesn't move up. And earning, of course, moves up with every year. But until earning moves up, as long as we earmark saving and as in the equation, and earning minus in consumption should not be saving is something one has to be mindful about. So, but most of the times, a lot of individuals do not know what percentage you really end up saving because it's really something which is left over, not something which has been planned for. So just think for yourself. No need to answer, like I said, but these are the questions which one gets confronted. Another very important question, which especially pandemic has taught us, that do we need to keep emergency fund side and what kind of emergency fund is adequate? Now, will the amount be same if there is only one person in the family working or if both spouses are working? Could it change? So a lot of these questions one needs to think about, one needs to plan for, but do we really plan? So again, it's a question for everyone to answer for oneself. Now, once you get into investments, and I think you saw what happened yesterday, market corrected by a huge 2,500 plus points, right? And these are the times one may incur principal losses, portfolio losses also. But why do one should still look at equity as an investments because the chances of making return is high. But will it differ individual by individual? Does the risk appetite also differ? And despite of knowledge of this fact that if one is willing to take a principal loss, one can actually make a higher return. Do we really do that? So the question here is that are you ready for a principal loss in the pursuit for higher return? If yes, how much? Up to 20%, more than 20%, or it's very difficult to answer, or perhaps one will get emotionally disturbed if the portfolio turns into red, if 100 becomes 90 rupees. So again, these are the questions we need to find answers for before we really go into financial planning. And I had said, again, a very important aspect of our financial planning, whether we are protecting our family through life insurance, we are protecting ourselves for health insurance, do we have adequate cover? So a lot of times people have a lot of small policies of 5,000, 10,000, but that is not sufficient to protect oneself or to protect the family members. So what kind of cover you have? What is the right amount of cover one should look at? Do you really know? So these are really the questions which we'll try to seek an answer for during the session today. And like I said, there is no right or wrong answer for all these questions. And the reason is that every individual has a unique circumstance. So your risk appetite will be different, your financial goals can be different, your cash flows can be very, very different, even if you are in the same pay grade. Because like I said, the equation can be savings ahead of expenses, or it could be a leftover in earning minus expenses is equal to savings. So where do you really place savings will decide how much of cash flow you really end up. Then the choice of instrument can lead to a very, very different return. So there are instruments where you end up giving or paying more tax vis-a-vis some other instrument, right? Do you need liquidity at all points of time? Now, such requirement can actually alter your investment decision. Then you cannot go into something which is long-term in nature, even if it is more rewarding. Inflation really impacts everyone, but it impacts more people who are spending more than saving more, right? Because if you're saving more, inflation will also mean that you get a higher rate of return in what you're saving. Time horizon can differ, and I think Another very important aspect of your decision making is life stage. So while most of these are common, and yet people in different life stages will react differently. And the reason is very, very simple, that your requirement in all the life stages are very different. So we classify it into phase three, wherein the first phase is more about getting ready for life, preparing oneself for life. But once you get into phase two, and that's where we start earning, there's a lot of event one has to plan for. So it's not very smooth in nature. You have to keep planning for various events because there are expectations which you have for yourself. There are expectations which you have uh, for your family. And there is also an expectation which family has with you, right? And as a bread earner, as a senior in the family, you have to meet a lot of these requirements. Now, each of these requirements has a bearing on how your financial saving habit may uh, change, and with each of these passing events, right? So very, very important. But while one is in phase two, is the right time also to plan for your phase three, which is golden years. So if you don't plan for retirement in time, uh, the retirement might not be as happy as one would have wished for while you were accumulating wealth during your earning years. So while so very, I'll also touch upon some of these numbers just to show you why there is so much of importance of starting early when it comes to retirement planning. So each lifestyle stage, the same individual during the different life stage is expected to behave differently. So when you one is at 35 years or at 45 years or at 55 years, the same person, despite of having this all the questions which we saw in the previous slide, will behave differently. And what are these differences? So these differences are, of course, uh, uh, is a outcome of the stage you are living. It's an also a outcome of the earning which you make. So when you start your job or even your early stage of life, you end up spending most of your earnings. You don't have much surpluses left to save. But once you grow up the ranks, you have more surpluses, and that is also a great time to start putting a separate wallet for savings so that you can plan for your retirement very well. So as you can see, each of these stages will have a different requirement. At young stage, you should look for higher protection because you don't have enough saving for your family member in case some untowards happen to you. So building a protection layer becomes very important. And as you progress, we keep meeting each and every goal, right from buying our first car to buying a house, or even spending money on leisure and vacation, right? But as you move to the stage two, and is the right time when one needs to start planning for retirement. Now, all of these points, there is also an element of borrowing because there are a lot of loans available which help one realize a life goal much earlier. Unlike our previous generation, for example, who will spend the entire life saving and you accumulate a corpus and then you go and buy a house. Today, no, and not today, I think for many years now, for last few decades, I would say loans have become very, very easily available. So you can actually plan and buy a house much ahead in time. But the point one has to be careful about is how do you service it and how much do you stretch while you are buying or a house or you're taking a loan, right? So these planning becomes again very, very essential in your final for corpus creation. So again, the problem or the question comes into that if I have to plan for retirement, why is it important and why should I really plan early? And I'm touching upon this aspect because a lot of financial management we do in life is actually anchored around such a requirement that, okay, post retirement, even if I don't have pension, I can have an annuity income, I can have a monthly income which can take care of myself and my family and hold me in good state. So the question is, why is it very, very important? The first phenomena which we are witnessing for over a long time is that the interest rates are going down. So we have seen that FD interest rate used to be double digit not long back, right? And we have now down to 4-5%. While we expect a reversal to happen, and the reversal is also happening at this point of time, but it may not inch up to the same level. So with the corpus which you have created, no more you get the return what you used to get earlier. So that really takes away a part of your income which could have come from your assets. The second big factor is that the medical costs are really zooming up. While we see, and with advent of technology, whether it is about a mobile phone or it is about car, the cost hasn't gone up as much. So if a basic car was available for 4 lakhs 20 years back, you can still buy a basic car for 4 lakhs today. But the doctor, if consultation fee, if it was 100 rupees in cities like Bombay where I live, it can be as high as 1500 to 2000 rupees for a basic consultation. And of course, if there is a hospitalization or surgery requirement, it can be into few lakhs. So as one gets old, the chances and the requirement for medical attention will only be high. So clearly a very strong and big reason why one needs to plan in time. Third is the fact that Indians are living longer now, and clearly with better nutrition, better medical facilities, that's a positive change which we are witnessing. So when you're living longer, post retirement, it is no more about 5 years and 10 years. It's actually about 25 years one has to plan for. And as we know, very few people have pension, very few social securities measure are available. Even if it is available, it may not help you have the same lifestyle which you had while you were working. Nuclear families, of course, makes it challenging. And inflation is something which, of course, keeps attacking our corpus. And that's something, again, we have to plan for. So all these six factors in really is a reason why we should plan in time and plan and really uh, and not just that you plan in time, but if you really plan early, the impact which you see is huge. Now this is a slightly complicated, maybe a table. I'll try to make it easy. So we have taken few examples of people who are at different age. So just if I can highlight maybe a second. So let's look at the first example where somebody is 30 years old and one starts thinking about retirement this early in life. A lot of people don't do. Perhaps I have also not done at that age for sure. And then there are a few examples we have taken at maybe interval of 5 years. Now, what does this tell us? That let's assume our retirement age is 58 years and we are able to grow our savings by 10% per annum until I get retired, and post that it is 5.5%. And the reason why I'm changing it because we spoke about the life stage. So the risk appetite of an individual will reduce. And if you are chasing higher return here by taking higher risk, probably you would want to conserve your capital and not take a higher risk. So we have said that, okay, post retirement, the corpus will only grow at 5.5%. Inflation, which we have taken at 4.5%, which has been the case last couple of years broadly, while the current inflation is high because of supply side constraints. And the expectancy is 85 years. So these are the common factors we have taken. Now the variable here is that in case this individual has a 50,000 rupees monthly expenditure today, and you don't want to compromise on your lifestyle. Now what does that mean? That post 58 years, every month you should get 50,000 rupees equivalent money. So by equivalent, I mean inflation adjusted number. So the inflation, this number could be 2 lakhs, 3 lakhs, 4 lakhs, whatever is the inflation adjusted number. But as at the current price, at today's price, one should get 50,000 rupees per month. Now to create this monthly annuity from retirement age till 85 years of age, you will need a corpus of 4.76 crores when you turn 58 years. Now this looks huge. Now just think about somebody whose current monthly expense is only 50,000. And to this individual, I am saying throwing a number which is 4.76 crores. Perhaps the first reaction would be that I don't know if I'll be able to save that much. Or I should start worrying about my retirement straight away because probably I'm staring at something which looks very daunting to me. But the answer it is not daunting. It is very simple if you plan in time. And it is as simple as just putting 25,798 per month. That's about it. So if you invest this amount every month at the age of 30, you will have 50 rupees per month available till 85 years of age post retirement, and you will build this corpus of 4.76 crores. So it sounds interesting, right? Now let's look at another example. Every parameter is same, but I have turned 35. Probably I didn't choose to do it when I was 30. 5 years gone. My expectation is the same. But now since I'm 5 years older, Here I was getting impacted by inflation for 55 years, 30 years to 85 years. Here I'm getting inflation impact for 50 years because I'm already 30. Hence, I need a lesser corpus at the time of when I retire, which is 58 years. So I will need 3.82 crores, not 4.676, because 5 years is the inflation which is eating up into my corpus. So to this individual at 35 to have the same lifestyle, now you require 35,565 monthly saving. So if I started on at 30 years, I needed 25,798. Now I'm needing 35,000. It's gone up by 10,000 per, almost 10,000 per month. So just 5 years relay, and the impact is, though it is just 10% per 10,000 per month, but in a percentage sense, on a 25 rupees, you actually need almost 35 to 40% more per month to get to what you would have got to if you were planned 5 years early. So let's move forward and look at a situation three where I don't plan it till for 50, 40 years. And now to get this number of 50,000, I need a corpus of 3.06 crores for which I will have to save 56,745 per month. So delaying by 10 years has almost doubled the amount which is required to get the same lifestyle post retirement. And let's look at one more example wherein I just increase this for 50,000 requirement to 60,000 and I delay it by another 5 years. And now the requirement becomes 1,07,000 to hit a corpus of 2.95. So clearly this four examples tells us that while saving 25,000 rupees may not be too difficult when one is 30 years old, but not saving that 25,000 can really uh, create a lot of difficulty once one becomes a little old. And I'm not even getting into example where people have not planned beyond 45 years also. And I'm sure these examples will guide you and probably make you start thinking in that direction. So why does it happen that when you start early, you really are confident that you will be able to have a very, very happy golden years? And the answer lies in a simple concept called power of compounding. This chart basically is an example wherein I'm assuming that I can manage my wealth very effectively and I can grow at 15% per annum. Now these are very, very high numbers to target, honestly, but let's, for assumption, I'm saying we can do that. And all I do, I invest 10 lakhs rupees. So what I observe is that if I invest 10 lakhs, 10 lakh and at 15%, it doubles in 5 years. So it becomes 20 lakhs. But if I leave this money and I don't touch it for next 20 years, I will have a corpus of 16 million. And in the last 5 years, it becomes 16. Now it is still doubling. It is becoming 16 is again doubling. But the amount of corpus which you created here was just 1 million in the first 5 years. But in the last 5 years, you have created 8 million. And that's really the power of compounding. So if you start investing early and you let the money to grow for a longer time, you will actually have an asset which will take care of your golden years very, very effectively. So that's a message which I wanted to share, why one needs to plan early, and by planning early, the power of compounding can take care of your all your worries. So if it is so simple, why one fails to do it? I mean, looks so simple academically, right? But generally what we observe is that, and that observation is based out of a lot of meeting which we have with people, that primarily perhaps one has not sat through and thought of about it. So there is no plan in place. So if there is no plan in place, it becomes ad hoc. For example, an X and Y advisor will come or a family member will come and tell you to, okay, to invest in so and so things because the person who is suggesting has seen a high return. And we follow these advices and start placing some amount and randomly here and there. So not having a plan is the biggest mistake which we find in financial planning. But there are other mistakes also which we commonly come across. So there are people who invest and forget, or there are people who are tracking it every hour or buying and selling every day, which is so a passive style or a ultra active style. Both are detrimental to creating large corpus, as we have seen what stability or patience can create through 20 years of power of compounding. The third point is when you start relying too much on yourself or also on portfolio manager. So here I'm actually putting a caveat that while I'm coming and giving suggestions, at the same time, every word I speak should not be seen as a gospel truth. One needs to put it on a test scrutiny for oneself and really pick up what is relevant to oneself and to the style of investment one wants to follow. So if you rely on yourself or if you rely only on the probably news or portfolio manager, again, you run a risk of not doing something which is wise. Now, that's some of the complete. So these are more of the first few points are more about behavioral. So let me look at some of the uh, numerical points. So clearly, every product comes with a certain amount of risk, and there is a associated return which one should expect or one does expect, right? One needs to understand the dynamics of risk and return, and we'll also talk about it in detail later. So I'll leave park it here. I gave example of chasing performance through hearsay. Somebody has made money, so I should get into the same product. A lot of noise around us. So we currently, as you see, there's a lot of noise yesterday. Why market went up today? The noise is the same, but we overreacted yesterday. Perhaps we positively reacted today. But a lot of attention to media and noise do impact our investments behavior. Again, quantification of our losses is something which we are very, um, I would say, not happy about. So we will rather never want to book anything which has given us loss because we want it to turn profitable. And we'll wherever we see profit. For example, if we have two options, so if 100 has become 110 and 100 has become 90, we'll be very happy to sell 100 which has become 110 because I see profit, but I'll not sell 100 because which has become 90 because I'll want to wait it out for it to become 100 and more. Now, what we disregard here that 100 has become 90 for some reason, probably it can become 80, and 100 which has become 110 for some reason can become 120. So you are selling something which has a potential of future return, and you are not selling something which can further cause you loss. And the last point, and I think very relevant point, is that investing is not speculation. It is not about tips. It's not about hints. It is not about what gets published in newspaper or gets spoken on business channels. It is a disciplined process. And as long as one follows the disciplined process, you may not make the best return, but you will obviously make a much more stable return. So what is the right approach of financial planning process, or how do we do financial process planning as far as we are concerned? So I think the first and foremost part is really sitting down with a pen and paper, probably putting down your financial goals. So what is that you want to achieve? What are your expenses, whether it is a car purchase, whether it is a marriage in the family, whether it's your children's education, and so on and so forth. So listing down your goals is very important. Then we conduct a exercise called risk and financial profiling, and I'll talk about it subsequently why this is very important. The second part, and that is this profiler which I have spoken about gives us an idea of a concept called asset allocation. So what is asset allocation and how does it impact us? I'll again talk about it in detail. So as a portfolio manager, I would want to know the risk profile of the investor, the goals of the investor, basis which I will arrive at asset allocation. So which are the asset classes? I'll probably talk about it in a while. I will do the scheme selection basis the research capability which we have. So we have our in-house analysts, we have a lot of liaising we do with industry experts, CIOs of mutual fund companies. Our treasury does market research, global research. So all these expertise analysis comes into our product selection, and that product selection becomes part of your portfolio creation. We have a platform which allows you to invest online through internet banking, through mobile banking. But the life really doesn't end here. This is a continuous process, right? Because once we have created a portfolio, that portfolio has to be reviewed. So how do we review the portfolio? There is a single portfolio reporting which has all the analysis of your company holding, industry exposure, if you're investing into debt, how much it is into AAA, AA. So all this becomes our file through which we can constantly review the portfolio, and wherever required, the portfolio has to be rebalanced. So this is not a linear process, if you ask me. At all points of time, we can always go back, and we have seen in the life stage that life stage is your goals can change, and once your goals can change, the next two circles should also change. So it's a continuous cyclical process one gets into. And while we are doing it, it has to be backed by a very, very solid research, which will help us get more of the financial market. Okay, so asset allocation, I think this is, if you ask me, the key slide and has a lot of insight available. So what do we really call as financial assets? So if you look at assets, of course, real estate, our self-occupied houses, property, land, all are assets also, but they are not financial in the nature because you cannot transact on a very free basis, right? It has its own set of limitation when it comes to liquidity. Even prices, you will not know. The same house can sell for different rates at the same time. So we are limiting our discussion right now to equity, uh, gold, and debt we have classified as long-term debt and short-term debt. So LT stands for long-term, ST stands for short-term. So what is the difference? The difference is like a long-term debt will have bonds which are 5 years, 8 years, 10 years, longer tenor, and short-term debt will have bonds which are 6 months, 1 year, 2 years, lesser tenor. So these are the four asset class uh, which basically is through which we do asset allocation and we create a portfolio. So here we have taken an example of an portfolio which has 45% money invested into equity mutual funds, 45% into debt mutual funds, and 10% into gold. Now, what we are additionally doing here is that we are annually rebalancing the portfolio. So what does annual rebalancing mean? That let's assume I have 100 rupees which I have invested. Now out of 100 rupees, I have invested say 50 rupees in equity and 50 into gold. Now it is possible that 50 will become 60 and gold 50 might become 55. So next year I don't have 100, but I have now 115 rupees. But if my ratio has to be 45, 45, 45, I will sell if equity has given me more return. I will sell equity and go and buy debt and gold, which has given me less return. So in this process, I am booking profit of equity and putting into conservative asset, which is debt and gold. So there is a constant equity balancing. Let's look at another scenario that equity has corrected. What happened yesterday? So let's assume this 45 has become 40. In that case, I will take some money out from debt and gold and go back and buy 5 rupees of equity and make it 45 again. So this is rebalancing, which I spoke about in the previous slide, and we do it annually. So this is a model through which we wanted to study the numbers. Now, what do we observe here? So the first row is the best performing asset class for that calendar year. So we have populated returns of asset class from 2016 till last year. So we saw in 2006 and 7, equity was the top performing asset class. So equity gave a return of 48% and 62%. Gold gave a return of 20% and 18%. Short-term debt 6 and 9, long-term debt 6 and 7. So these were terrific years for investments because everywhere people have made positive returns. But 2008, if somebody will recall, and if you were invested in equity, we know Lehman collapse happened and there was a lot of subprime crisis and equity tanked. So equity in 2008 gave negative 50% return. So if you had invested 100 rupees, you were left with only 50 rupees in the subsequent year. And gold gave as high as 26. Long-term debt gave 21%, debt gave 21%, debt gave 12%. So very, very bad time for equity, but look at the first three. They have given double-digit return. Now let's assume an investor having seen a 50% erosion will say that, okay, I will never go back into equity ever because I've lost half of my money. What happened in the next year? Equity gave 90% return. So if 100 had become 50, that 50 became almost 100 back in 2009. So whatever was lost in 8, people recovered if you would have not have exited. But there are in actual two things happened. People who lost money booked money by 50 rupees loss, and then there were people who came with 100 rupees here and they made 190 next year. So these are times when one has to manage the emotion part, and Again, look at the discipline of investing over the worry of speculation, because then only you can make long-term returns. So the message here is that each year, if you see, there are different asset class which are giving higher return. In 2016, debt gave 17%, while equity only gave 7. In 2015, short-term debt gave 8. Look at this year. The top performing asset class in 2015 was debt at only 8% return, and gold gave negative 7%. Gold gave negative 5 here, no gold gave negative 8 here, gold gave negative 7 in 2021. So another myth that gold doesn't correct or gold doesn't get negative return is something which is being challenged. So we have seen negative return across asset classes, except of course for debt, but debt also the returns has gone down as low as 1%. So this is a reality. So we have, in the last couple of columns, we have tried to see what happens over a long period. So we have calculated from 2006. So annualized return, compounded annual, CAGR stands for compounded annual growth rate. Gold has given 12%, equity has given 12%, long-term debt 9%, short-term debt 8%. And what I mean by volatility, that gold could give 12 plus 14 or 12 minus 14. Similarly, equity could give me 12 plus 30 or 12 minus 30. So that's the rough way to look at volatility if you have to make a oversimplistic assumption here. While debt is much less volatile, short-term debt is even less volatile. So it has never given a return less than 3-4%. So the one way of approaching this entire thing that, okay, I don't want any volatility, I'll put everything into short-term debt. But then you compromise on return, because then you will never see this 48 and 26 and 62 ever. And if that is the assumption, you will not have that 15% per annum assumption, and you can't see your 1 million becoming 16 million over a 20 years period. Then what we should do? So what are these grays? Gray cell. And that is exactly where the crux of this asset allocation is. So gray cell is nothing but portfolio. A portfolio which is 45% in equity, 45% in debt, 10% in gold, and which is rebalanced annually. Now, what does that happen? It doesn't give you top return ever. This portfolio is never in the first block. Cannot be, because you are investing into multiple asset classes. But what you see here, that portfolio a lot of times is into the second block, second row, or third row. There are only 3 instances where portfolio is in the fourth row, and there is not a single incidence where portfolio is in the bottom row. And only in 2008, this kind of a portfolio has given negative return, and in 2011, 4% negative return. Otherwise, the portfolio has never given a negative return. So this is the power of asset allocation and rebalancing on an annual basis. And if you look at the return of portfolio, the portfolio return over all these years is 12% with only 13% volatility, which is lower than gold and equity both. So with less fluctuation at a portfolio level, one has made the return what you could have made only by only being in equity, but facing this kind of volatility. And the problem with this kind of volatility is that one may lose nerves and sell out with 50% negative return and never get back into equity. So that is really the message here, that one should diversify into multiple asset classes. One should definitely be in equity, because if you're not in equity, then you're compromising your return into single digit, which will be equivalent to inflation. And then, as we saw in the retirement chart, that there also we were targeting a 10% growth return to achieve those numbers. And 10% in debt is a very rare event. So we see here 10%, we see here 10% plus, but more often than not, you will see single digit return in debt. And hence this mix of equity and gold becomes important. So asset allocation is really the discipline uh, which one needs to follow in financial planning. So the next obvious question is that, will asset allocation be constant for everyone? The answer is no. So we just looked at a model of 45, 45 and 10, but one can choose an asset allocation depending upon your own risk profile. So we classify investors as risk averse, conservative, balanced growth, and aggressive. Aggressive are investors who are willing to take more than 20% loss also. Remember the question which we had at the start of the session. So these clients are seeking aggressive return. These investors are seeking aggressive return, and they are okay if the portfolio corrects. They can emotionally manage the 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 difficult times when your portfolio returns become negative, because they understand that over a long period of time, and as we have seen in the previous chart, one can actually make a higher return. So we classify each of these investors. So how would each of these investors behave? So somebody who's completely risk averse should look at bank fixed deposits 50% and debt mutual funds 50%. So this is how your 100% of portfolio can get uh, constructed. A notch higher, if somebody is conservative, we can still introduce some portion of equity through a dynamic asset allocation, which is a blend of equity and debt, and some small portion into equity mutual funds. Similarly, for balance, this percentage goes up. For growth, it goes up even further. And if you look at aggressive, aggressive is somebody who is willing to put almost 80-90% of the money into equity and a very small into uh, gold. And gold, we have taken sovereign gold bonds because it is the easiest way of investing. Plus, over and above gold return, you also make a 2.25% interest. And on maturity, there is no tax on gold. While if you buy a gold biscuit or you invest into gold, and there is a capital gain tax of 20%. So this is clearly a preferred vehicle as far as gold investments are concerned. And mutual funds and all these, we have a research desk which we identify, and there is a lot of funds options available in the market. But I use our research and identify, and we create a shortlisted fund for our investors. So broadly, this is a very, very important slide. Each individual will behave differently. uh, from two different people at same age will behave differently, and the same person at varying age will also behave differently. So one over a life stage cycle of 85 years can turn from aggressive to risk averse as well. And typically it happens as you go older, because your focus becomes conserving wealth rather than creating at a massive speed. So this is how we do asset allocation. Now, just a while back, I had mentioned in the financial process that we do a financial risk profiling. So that's a set of questionnaire. It is score-based questions, and basis the total is how we classify investors as risk averse, conservative, balanced growth. So this is a process which is very, very objective in nature, and through a score-based open-ended questions, multiple choice questions rather, we classify people and construct portfolio accordingly into all these options which are available to us. So moving ahead, while the previous product spoke about the options which are available to investors depending on the risk profile, another very important aspect is how do you profile a product. So there we profiled a client or an investor, and accordingly we said that okay, this should be the portfolio allocation. But the fact that there is a risk inherent in the product, and that has to be also understood very, very intelligently. And this is why the risk return dynamics, which I spoke about earlier, has a big role to play. So let's look at some of the examples which are listed here. So bank FDs is low on risk. It is medium on return. It is not bad, but not great. Liquidity is medium. You can take loan against FD also, which can provide you liquidity. If you have to still break your FD, you can do it, and you can do it for various time horizon. I mean, at the current rate, savings account interest rate and short-term FD rates are same. So typically, you make better return only when you place it for a year and more, and you can go up to as high as 5 years and more. The second option is debt mutual fund. We saw short-term debt and long-term debt in the asset allocation slide. So this is LT and this is short to medium, ST and medium term. So long-term is slightly higher on risk. So the risk here is low to medium, while short-term is low on risk. Now this gives you a return which is better than fixed deposits. Liquidity is moderate because you may not want to sell it at all points of time, and time horizon will be more. But with short term, you can actually, with liquid fund, for example, you can invest for a few weeks and it will be low and liquidity will be high. So these are debt options. And then once we go into equity options, we have equity mutual funds. This is high on risk, but high on return. But how you mitigate the risk? By holding it for longer time, which we saw in the asset allocation chart, that if you hold it for a longer time, Even if you had 50% negative return in 2008, you would have made up for the losses by holding in 2009. And you can only make up for the losses when you holding period is high and you don't need to sell to use that money. So equity mutual fund is for people for that part of basket which can be put aside for longer. Again, among equity options, there are two more asset class, PMS, Product Portfolio Management Services, and AIF, Alternate Investments Fund, which are low on liquidity and can aim a return which is even higher than equity mutual funds. So this is for people with more than say 5 crores of financial net worth. So these are high value ticket size and holding period and liquidity low. So this is how we classify the products which are available in our basket, and we look at the individual risk profile and accordingly do the product selection. I spoke about two important aspects of financial planning, which is term insurance, which is life and health. I think very important because since hospitalization cost is going up, your financial planning can go for a toss. Let's assume the money was parked aside in equity and equity market corrected. Let's take a classic example of 2020 April. So equity corrected, and let's assume there was a COVID in family and one has to sell those equity at half the price for the hospitalization coverage. So your money, which should have tripled from that time, was consumed in hospitalization, and you would not have the benefit or power of compounding. So, which is a simple way of protecting? Have pay some small premium, have a cover. It could be worldwide cover, it could be India cover, depending. It could be a family floater, but definitely have a cover, and over and above what one has through the employer. So, and term life, again, if typically it should be 10 times of your annual income. So if somebody has 30 lakhs of annual income, you should not look at a cover of less than 3 crores, because inflation will keep eating into that 3 crores. What looks very high today, after 5 years will have half the value. After 10 years, it will have quarter the value. So one needs to look at a cover which is more. And if you take early, then the premium is low and medical requirements will also be simpler. So a very important aspect of financial planning, other from product selection, is planning for risk insurance. And the last bit which I spoke about is also about your succession planning, because while you're doing it, you should also be cognizant of the fact that it should get transferred to your inheritors in a very seamless fashion. A simple instrument can of will can make a lot of difference, and a lot of times we confuse ourselves that okay, probably I'm a nuclear family, I have only one child, so everything will go to my child. But what we and I have nominated my child. So what we miss out is that if I, as an individual, if my parents are alive, they also have the right to my assets. Not so it's not as simple that it will go to my children. So and each it is it gets governed by civil codes. Gets governed by various family laws. Each state can have a different law. Each religion can have a different law. So one needs to really look at the right option, and the simplest option is putting a will together. So this again we think is an important aspect of financial planning, because right from saving to expenses and meeting your bulleted goals of buying a house, buying a car, marriages, to planning for retirement, and finally it boils down to devolution of asset to your next generation. So each of these aspects are important. Now, since we only have few minutes left, I'll quickly try and cover and probably take questions. So what we do as a group, we clearly are leaders across uh, multiple businesses in financial services. So we are a large financial services conglomerate, and in our advice, we seek expertise of each of these group. So whether it's general insurance, life insurance, broking, ICICI Direct, property services, all of it comes into a picture when we create as far as the research is concerned, when we are creating a portfolio. So under wealth management, we have two segments. So we have, if I define it in terms of salary, 50 lakhs and above salary comes under wealth management, or one, if somebody has an asset of 25 lakhs, they can also get a wealth management account. 3 CR and above is wealth select account. What we do is full banking plus investments to you, and in wealth select, for example, we also take care of real estate services, will writing, AIF and PMS, which are high value products. So we have a range of products available to customers belonging to the two segments. The other advantage is that any individual who has a wealth or wealth select account, the entire privileges are extended to family. These comes with zero balance account. There is no charges on demand draft and so on and so forth. You get internet banking, mobile banking, all complimentary. Plus you get debit card, which is again higher variant. Another very important aspect of how do we manage is that for each of the relationship we have RM and a senior RM. For Well Select, we have senior RM and the relationship manager who are assigned. We have service RM also assigned, and for and then we have investments or product specialist who support and assist the RM in creating and reviewing a portfolio. And people with who are self-employed or business banking requirement, we also cater to such requirements. So we have multiple people who service the need of a client as a process. And I spoke a lot about advisory, how group company really helps. So we have this committee called Global Investments Council. This committee meets every month. We have head of our treasury, CIO of ICICI Prudential AMC, head of our corporate banking. All these gentlemen, along with our investment research team, they come together and look at all the events and take a call of what should go into suggestion and into the portfolio of our investors. So that's the approach we take. Our products are few, suite and basket is very wide. Some we offer to Wealth, some we offer to Wealth Select. For example, global funds we normally offer to Wealth Select only. AIF and PMS we offer to Wealth Select. Overseas investments we offer to Wealth Select. So depending on the needs, we can create a wide basket of portfolio through the products which we have. Every banking needs, right from your savings account to FT to loans to forex to travel, is something which we can service, and a lot of other stuff we can do. Some on life insurance, general insurance. If you want to remit money outside using LRS, if you want to take a loan against your mutual funds, ESOP funding. So a lot of it we can do through our services. Now, the interface which we have is again very beautifully digitally enabled. So we have retail internet banking and mobile banking, which allows you to have multiple options available on those platforms. I think we keep getting recognized as perhaps the best in the world when it comes to our internet banking and mobile banking. So a lot of good features, and I'll just speak about one simple feature in mobile banking. So we have our app is now called iMobile Pay. So anybody who used GPay, for example, you can transfer money through iMobile Pay. Even if you are not an ICICI Bank account holder, you can download. And as we speak, there are 5 million, 50 lakhs clients who are not an ICICI Bank account holder using our mobile pay for a payment app. So you can link your existing account and you can make any UPI payments. And this has a feature called pay to contact. So once you put a phone number of your friend or a colleague, you will get all his UPI handles. So whether it is on phone pay, whether it's on GPay, you'll or it is with another bank, you'll get those as a drop down and then you can select and pay. So it's a very convenient way of paying. And this is why something which we are getting a lot of appreciation for. So a lot of such features are there. You can do your investments also through mobile banking. Um, Change your debit card limits, block your card, or see your statements. So multiple features just makes it very convenient for us. Lastly, there is a series of uh, a series which we started in June of last year, which we publish every month. I'll request all of you to go through it. We'll supply in case it's a PDF book, which is a very simple. We have tried to make it jargon-free, simple communication of the requirements one may have in finances. Uh, Go through these book. We try to just whatever we have tried to cover today, we try to reinforce through these engagement program which we run through this Orange book and Orange series, and in a very convenient way. So we'll share all of this with all of you as well. And I think clearly a lot of awards we keep winning on the largest, strongest bank, on internet banking, on technology, on retail banking. And I think that should give every listener a lot of confidence when you bank with us and also on the portfolio management and wealth management side. So we've completed just in time, I would say, maybe a few minutes later, but I will still if people have time and there are questions, I'll try to take some questions.
Sure. Thank you so much, Vikas sir. Okay. So if there are any questions, please post them in the chat box or you can directly talk to Mr. Vikas. The session is now open for Q&A.
So I think, Asmita, if anybody has any question, he can unmute and ask. I think so.
Yes, yes.
So, sir, if anyone has any question, you can please unmute and ask. So, so I don't think anyone has any question. But in case anyone has got any question, even later on, you are free to call me. Can you display my number and Sudhir's number, Vijay or Asmita, if possible?
Sure. I think we have a raised hand by Mr.
Okay,
Thakur
yeah.
Ajay Kumar Vishwambar. Sir,
Yes, sir,
can
please.
you unmute yourself?
Hi, sir. Good evening. Just one query. What is
Yes.
the suggested balanced investment among the equity, debt, and all for a person who is somewhere between 45 to 55?
Uh, okay, sure. So I'll answer it in a way that one, I don't I and that's what I kept saying, that there is no right or wrong answer. So everything is dependent on individual. So at 45 years, somebody can choose a very aggressive bet, somebody can choose very defensive. But since you also set balance, there are way of approaching it. So the simplest way of approaching balance is perhaps through the portfolio which I had showed in my asset allocation slide, which was 45 mutual fund, 45 debt, and 10% gold. So I think that is as balanced as it gets in terms of portfolio, because it has flavor of all asset class, and and will not be subjected to too much of volatility as we have seen. The other way of doing it is through a simpler product called Balance Advantage Fund or a asset allocation fund. So what these funds do, that they do it, or rather these could be an inbuilt fund. For example, a Balance Advantage Fund category in mutual fund can have a mandate of being 20% into equity or 80% into equity. So they have certain valuation model. So you don't have to do manage your balancing on a real annual basis that I had shown. They do it regularly within the fund. So if they see the valuation has gone up, what they will do, they will sell their equity from 80% and bring it down to 60, 40, 50, and even 20% and buy more of debt. And if the market corrects, they start using the debt money to buy more of equity. So this can be achieved within the fund through a product category called Balance Advantage Fund. Then there are asset allocation funds available through iPro AMC platform, wherein there are multiple funds which are part of the portfolio. So this is a fund of fund. Now again, the fund of fund will have some equity funds, some debt funds. So depending on the ball balance, again the valuation and the market outlook, one can go, the fund manager can go more into equity or less into equity, and this is how they manage the portfolio. So two ways to do this. A simpler way is you take a balance advantage fund or a fund of fund so that the rebalancing can happen by itself, or a slightly difficult way, and especially I would not say difficult, because if you want more flavor in your portfolio, then you can buy say 45% of mutual fund equity, 45% into mutual fund long term and short term, and 10% of sovereign gold bond, and achieve your balanced portfolio.
Thank you. Is conceptually the balanced advantage fund and the multi-cap fund are same, or
No,
it is
no,
different?
no, they are different. Multi-cap fund can have all market capitalization and gold as well, but the objective is not to use market valuation and move money into debt and equity. The objective of balance advantage fund is to move between debt and equity to create a portfolio which doesn't have very high equity exposure at all point of time. And if equity exposure is at high, only when the valuation is very cheap. And that is what we have seen in April of 2020. The balance advantage fund and equity portfolio had gone up to 70-75% also. Multi-cap will invest into large cap, mid cap, small cap, and will be more risky than balance advantage fund.
Thank you, sir. Thank you very much.
Welcome.
Any more questions from the participants? So if there are no more questions, or in case you want to reach out to the executives of ICICI Bank, these are the numbers that are displayed here. Ranjit sir, would you like to add in something?
So anyone having any question later on also, I request you to call on this number. My number is displayed there on the screen. So please do not hesitate in calling me and getting your query resolved. I will get in touch with Mr. Vikas and get your query resolved. So thank you so much. That's all.
Thank you everyone for your patient listening, and we have a wealth management presence in Jamshedpur. So we have a team of RM and portfolio specialists along with branch head as well. So any requirement, I think we will be very happy to connect and further service. And if there are questions which comes up, Ashmita, even after this session or otherwise, we can create an FAQ and circulate.
Certainly. Thank you so much. So thank you, Vikas sir, and Kumar Ranjit, Mr. Sudeep, for organizing this session. This was indeed very helpful. And okay, Mr. Tawheed, would you like to say something? Okay, that was my mistake, I guess. So thank you again, Vikas sir. We would love to have you in person here someday and deliver such informative sessions in future as well. And thank you, Ranjit sir. Thank you, Sudeep sir, so for organizing this session. And thank you to all the participants. Yeah, thank you to all the participants for joining in. For more upcoming events, please follow JMA on social media. So we are at the end of the session. Thank you so much. Have a great evening.
Thank you. Thank you, Vikas sir.
Thank you, everyone.